Right, well, good morning, everybody, and welcome to our investor update. And thank you, Dan, for that great music. Johnny Clegg, I don't know if any of you noticed the song is The Spirit of the Great Heart, and the opening line is the world is full of strange behavior. So on the eve of the SpaceX IPO, let's see what we can talk about that. So thank you for taking the time to join us this morning. With me, I have Andrew Lapping, our Chief Investment Officer, and Andrew's been with us for almost 5 years. Andrew and I have known each other for over 20 years now, and a fantastic investor. Many of you will have heard Andrew speak at previous webinars, but for those who haven't, you're in for a treat. And I also have Howell, who's our head of operations. Howell will be moderating the questions. We will have an extended Q&A session afterwards, so please line up some questions which you can put in the Q&A. And then also, just to say, from a compliance perspective, nothing we say today is, of course, advice. This is more for information purposes. Please do your own work. And also, in some jurisdictions, we're not allowed to mention performance less than a year. Given the number of questions and the regularity of these things, we will be referring to 6-month performance. And that, of course, is why when you look at our fact sheet, we refer to the monthly performance in the commentary, but in the actual fact sheet, we can only refer to annual performance. So with that, let me get going. So what you have here is the long-term performance of the fund in green.
Sorry, Sean, sorry to jump in here. Just share your screen.
Sorry, Dan. Okay, thanks, Dan. So what you have here is the performance of the fund in green, that's the green line, the MSCI World in blue, and the IA Global, which is an index of 577 global funds here in the UK. And over the last 6 months, we're up 2.7%. Over the last year, 14%. This is in dollars. And you can see we have lagged the world index and our peers over this period. And we'll talk to that obviously in a second. And there's the long-term performance with the quartiles. So most of that has come from recent months with the bounce back in some of these technology stocks, mainly the hardware stocks. And so if we break down that 6-month performance as to what has been the winners, what have been the detractors, you can see that our winners contributed 11%, our losers detracted 9.5%. We got 1.9% from dividends. There wasn't much in the way of an FX impact, and the total return for 2.7%. Our win-loss over this period has been slightly lower than normal, and we're going to talk to some of the winners and detractors in a second. If we look at the sectors, where has our contribution come from? Financials, the biggest contribution in terms of sectors, and healthcare second. And what's interesting here is that if you look at the world index and what the performance has been from over the last 6 months, healthcare is actually, interestingly, the worst performing sector. It's been very out of favor. And so here we've been able to generate performance from a sector that's been very out of favor, which is not unusual for us. Technology has not contributed much because we don't have much in the way of technology, whereas technology would have been the best performing sector in the MSCI World Index. And I guess that's one of the reasons why some people invest with us, is that it's blending us with many of the other funds which are closer to the benchmark just means you're getting returns from different places. And so that's the interesting point to highlight there. In terms of countries and regions, what has contributed? North America, Latin America has contributed. Asia ex-Japan has been the largest detracting region. We have quite a lot of exposure in Asia ex-Japan. We'll talk again, just focus in, and we've got a couple of slides on that, so we'll talk about that in a second. Now, I mentioned at the start that the reason we've been underperforming is some of the biggest performers the best performers have been the hardware stocks. And here's one example, which is Micron. It's a memory company. And what you have here is the net income of Micron in millions of dollars, excuse me, on the y-axis, and then the annual, the years, calendar years, on the x-axis. And what you can see is that Micron, there were years when it lost money, then it didn't broke even, then it made a bit of money, 14 billion in 2018, then lost money, broke even in 2024, made a little money. That's the history. Their biggest competitor is Samsung Electronics. So whenever this company has made money, they've had to invest in capex because if they don't, they're going to get eaten alive by some of the other competitors. Now, what you have in green is the analyst estimates, excuse me, of what the expected profit is going to be in 2026 and 2027. And so a sharp increase based off the AI capex. Of course, in the past, we've had cloud investments in cloud and PCs and gaming and other memory, using devices. So, but those are the estimates. To be clear, the green is not what has been earned. Now, how has that been valued? Well, you can see this is the market cap. Historically, all of a sudden, that's being valued at over $1 trillion. Okay, so you're taking very, very high earnings. The market is putting very high earnings on a high multiple. I mean, 10 doesn't sound too high, but this is a cyclical business. And if we look at it even deeper in terms of price to book, and what is book? This company has never paid a dividend, so its retained earnings and capital. And you can see that historically it's not really been priced at more than twice the retained earnings or book value. All of a sudden it's been close to 20 times. Okay. And so, book value, replacement cost, it's multiples and multiples of what has been paid historically. Interestingly, this is the best performing stock in the MSCI World Index over this period. So, this is why we don't own the company Micron, and we have a high active share. We're not expecting to perform in line with the market, or certainly not when contributors are from companies like Micron. Now, what's interesting is when you think about the expected profits that Micron is expected to make relative to the large technology companies who are investing in the capex. And so what I've done here is we've got the cash from operations, the capex in orange, and then the net cash balances for the combination of Apple, Alphabet, Amazon, Meta, Microsoft, and Oracle. Okay, and so you can see the blue bars, which is the cash from operations, has grown, as has the capex. The capex has grown at a faster rate, and because these companies have invested this cash from operations in capex and also buying back shares, because this cash from operations includes the add back of share-based compensation, we now have a situation where these large technology companies are in a net debt position. Okay, and so in that environment, one is expecting, the market's expecting huge amounts of capex. These are the expectations of the capex for these companies, and it's off the back of those expectations that you've got Micron's expected earnings. So when you put that together, this might happen. But it is interesting, and we referred to it in our fact sheet last month, that one of the most profitable businesses in the world, Alphabet, is now raising capital on the equity market. Many of these companies have also raised debt just to fund this capex. Okay, Andrew, should we talk about the China sector? Let's dive in a little bit there.
Yeah, thanks, Sean. I just some comments on that other stuff, which I think is important for people to understand, is people have become very flippant of large numbers. So there are only a few companies that have ever earned $100 billion in profit. So it's Saudi Aramco, Apple, Alphabet, and Microsoft, I think. 4 companies that ever earned $100 billion in a year. People suddenly think a commodity business, Micron, is going to consistently make $120 billion. People think Nvidia is going to make $320 billion a year in a few years. So I think Nvidia is also earning 100 now. But, even in the context of these people spending, those are very big numbers. And you would think the likes of Alphabet, etc., are probably not that keen on people like taking them to the cleaners and are doing something about it. And I think people often miss that with investing, is they ignore A, competition, and B, reaction to price. So a former colleague of mine, Sandy, always used to say, high prices solve high prices. You don't know how it's going to happen, but it's quite hard. You can't just kind of forecast in a straight line forward. But moving on to China, much more interesting. So we have quite a big exposure to China. We own lots of different companies, and it's been a detractor for us in the last few months. The Chinese market has been out of favor. for a few reasons. The first one is the Chinese consumer. I'm sure you have read in the newspaper is weak. So Chinese consumption expenditure is weak. The other reason China is out of favor is the US tariffs have impacted a lot of Chinese exporters. So these are a bunch of detractors that we've had in China. And so this chart will be available afterwards, and you can kind of glance. And you may not recognize some of these businesses. So I'll run through what they do, and you can look at the valuations. So Haier is the biggest or the second biggest appliance maker in the world, depends how you look at it. They own the brands you may have heard of. They own GE appliances, they own Fish and Paykel, they own Candy, they own Haier, trading at 8 or 9 times forward earnings. These are not our forecasts. I just took market forecasts to keep it fair. 8 or 9 times forward earnings, unbelievable track record of growth, huge investment in R&D. Then you look at something like Manwha. Manwha is the biggest producer of reclining armchairs in the world. Great uncertainty with exports to the US, come under some pressure. But again, fantastic track record, good business. China Feihe has got a very big market share in infant milk formula in China. And as I'm sure you know, the birth rate in China has collapsed. Well, none of the kids under 3. So their business has been under severe pressure. But that being said, the share price has gone from 30 RMB a share a few years ago to 3. So we've been buying it down at 350. And they're gaining market share, very well-run business, store majority controlled by the founder, buying back stock. As you can see there, net cash accounts for half the market cap. The enterprise value is only half the market capitalization, 10 times earnings. Then you get a stock like Haitan, which I'm sure you've all heard of. It's the biggest maker of injection molding machines in the world, absolutely crushing the German businesses. It's an American maker of injection moldings and German. I mean, Haitan, again, huge winner. Same CEO has been there for 25 years, 8 times earnings, net cash. Then you move on to something like Travel Sky. So Travel Sky is actually a semi-state controlled business, but they are basically the monopoly supplier of software to airports and airlines in China. Great long-term growth, 50% of the market cap in cash, 9 or 10 times earnings. Then you look at something like Chevron. This is Chevron Holdings. They, again, depending how you look at it, the either number 1 or number 2 seller of battery-powered garden equipment, snow blowers, lawn mowers, etc. in America. They've also got other brands controlled by the founder, unbelievable track record. Dream International, the world's biggest maker of soft toys, employs 31,000 people across Indonesia, Vietnam, and China, supplying to people like Disney, Mattel, etc. Again, fantastic track record run by the founder. Naga Corp, slightly different. It has the only casino in Cambodia. Great business, long-term growth potential as Cambodia grows, as Chinese tourism to Cambodia grows. So as you can see, these are not garbage businesses, but they've been weak. Price is down 20% on average. So we think we've taken a lot of our medicine on these businesses, and we're happy to own them here. And we get decent returns from this as well as our other holdings. But I think it's important to give you a taste of the type of businesses we own. These are not second-rate businesses. These are winning businesses at very attractive valuations.
Thanks, Andrew. Yeah, and I think also just to highlight as well is that we've had some winners as well, which we haven't included in this number. So, for example, a company like NetEase, which is our largest holding. So with these big moves, you can see that the actual detraction has not been enormous. So we have, just to bear that in mind. But as Andrew said, winning businesses on great valuations, for improving conditions. So let's look at the 6-month performance. What are some of the winners? Our biggest winner is DaVita, which is a medical business, and they have some 37% market share of the dialysis business in the US. We did really well. It was very out of favor, depressed. It was caught up with the negative environment and healthcare, and that often, well, that's where we look. And it's often where you can find great prices, because when great prices, stocks are out of favor, you get great prices. Petrobras obviously rallied strongly with the war in Iran. We have sold that. Sorry, we've also sold DaVita. We sold DaVita. In fact, we sold all of these companies. We sold Petrobras when it spiked up, and we were up some 70% on this position when you had the start of the Iran war. And then here, the Korean companies, Hyundai Mobis and Kia, did very well out of our Korean stocks. At the time we were buying Korean stocks, not even the Korean local population were interested in Korean stocks. They're all buying American shares. Of course, now that has changed somewhat with what's been going on with Samsung and SK Hynix. And Versant Media, that was spun out of Comcast, was depressed because often that's the case with spin-offs. You own Comcast shares, you get some Versant Media. It's a tiny holding in your portfolio, and many portfolio managers just get rid of it because it's more of an irritation. Sold down aggressively, and then that was attractive price, and we could buy that. So the important point here, we've actually taken profits on those. Whereas if you look at some of the losers, we still have Universal Health Services, which is a chain of hospitals in the US. Used to trade at around 15 times earnings. The founder's still involved, has shares. In fact, the founder's family members have been buying some shares, and it's now trading at 6 times earnings. It's been growing. It's a very well managed business. Betson, which is a gambling company in Switzerland, that has detracted a little bit. We've done very well from another gambling company in Switzerland. And so, yeah, that's detracted, but we get a healthy dividend. We still have Betson. We still have higher smart home, which Andrew mentioned. We did walk away from Mattel, and we're happy to do that. When we think that conditions are no longer as we were expecting and something has caused us to change our mind, we're happy to walk away. And we did that with Mattel. In this period, we lost 50 basis points. We did make money from Mattel in previous periods. And that is really what we're trying to do, that if we get it right, we make attractive profits. And if we get it wrong, we don't lose too much. And then we mentioned China. Fahey.
Sean, a question. What does percentage gross mean?
So thank you. So what that is of our losers. So what you've got is, Universal Healthcare Services detracted 1%, and that is 11.5% of our total losers. And what you found, you'll see this shortly. So the key point here is that often, certainly over longer periods, our winners are quite spread out. So we're not very exposed to our performance all be coming from one or two winners, whereas our losers are more concentrated, and that's because we make fewer mistakes. Thanks, Andrew, for clearing that up. So if we look at 1 year performance, you can see 26.6% from the winners, 12.5% from the losers, dividends a little bit more. FX did detract, and our total return of 4.7%. A consumer discretionary, the winning sector, financials, etc. What you can see is we have generated profits from most of the sectors. Now, one of the most underperforming sectors over the last year has been consumer staples in terms of the market. Okay, we've generated performance from consumer staples consistent with what I was saying earlier, but we've generated returns from most of the sectors. And if you look here in the 1 year performance, Europe has detracted. That's been the largest detraction from performance, and that's because of companies like Betson and, as you'll see over here, B&M, European Value, EasyJet, etc. Now, the reason I've highlighted these, just to talk about the losers, is that B&M and EasyJet have been very strong performers in the last couple of months. Okay, and B&M came out with some great numbers, far better than expected. Turnaround is proceeding well, and EasyJet is the subject of takeover speculation. And so I guess that highlights that when stocks are out of favor, and you're wondering what the catalyst is, the catalyst often is low prices. And it doesn't take too long for some smart people to come along and spot the opportunity. And so, in case of EasyJet, you have a number of private equity bidders currently considering launching a takeover for the company. Might happen, might not, but just to highlight that these things can change quite quickly. If we look at the contributors over the last year, you saw that consumer discretionary was the largest sector that contributed, and there was Expedia, which we still have. We've done very well in Expedia. Volatility is often our friend, and so Expedia, when we bought Expedia, it was quite out of favor, but it's a great business. They were cutting costs using AI. Revenue was expanding. Their B2B business was doing extremely well. And so Expedia started to re-rate, and we took profits at 287. Our fair value we thought was 300. And then what happened is Expedia got caught up in the software fears, and despite fantastic results, it sold off. And so that was another opportunity for us to re-enter the position. So that's why Expedia has done well. But that volatility caused by the market, we could use. Sally Beauty Holdings, I know I've spoken about this before, but it's a large chain of retail stores. They supply hairdressers and hairstylists. So it's colors and extensions and shampoos, and you have annuity income from that. But it's a small company in the US, and so small companies have not received much love, and we could buy it at very attractive prices. I've spoken about DaVita, and then Baidu. Again, we don't have any Baidu, and we don't have any Kia. Baidu, Chinese technology company. So the only ones we still have are Expedia and Sally Beauty. And
sorry, to clarify on something Sean said with that B&M and EasyJet. So this data is until the end of May. Am I correct in saying that?
That's correct.
And the reason Sean mentioned they not as bad now is because they're both up like 20 or 30% month to date because of, as Sean mentioned, potential bidding for EasyJet, as well as the oil price ticking down a bit with Trump's 15th peace deal in Iran, and B&M only reported in June.
Yeah, and since I wrote about EasyJet in the fact sheet, it's up 45%, and it's actually a profitable position now. So it is interesting how these things can turn around quickly. Here we have our top 10 holdings, and we've put our valuations and a couple of points here on the right. And I guess a key takeaway here for clients is that we don't have huge positions. We are not pounding the table saying we have high conviction. We didn't know whether Trump would have a peace deal or what was going to happen in Iran, but the price, of EasyJet was down at the point where it was effectively expected that the war would continue forever. What you also say, you don't see huge positions. We also, in terms of the comments, what you will also see is double-digit return on assets, things like that. These are good businesses that have grown, that are out of favor for whatever reason. And we're going to talk about Andrew's going to talk about Anta Sports in a second. I know last time we spoke about Greg's. We have a company, FactSet. Many of you will be familiar with FactSet, and we're up some 20% on FactSet. Annuity income. The perception is that AI is going to hurt this business, but in fact, we think AI is going to cut costs in this business. And so it's a fear what we like is when there's a fear which isn't actually a fact. That's what can often give rise to some fantastic opportunities. And we're pleased to see that Tencent recently acquired a stake in Kaspi. So we like it when other very respectable investors, can follow and see value where we see value. Should we talk about Anta? You want to talk about Anta Sports, Andrew?
Yeah. So Anta is a Chinese business, started in 1990 by the guy and his brother. They still own 61% of the business. And it's a kind of they call it a multi-brand strategy. So it's a sportswear. They own the Fila rights in China, and then they own Anta, which is their main brand globally. And then they've got a kind of another bunch of brands which is growing very quickly. Codon Sport is the big one, and Descente, which is not on here, and they've recently made some other acquisitions. Oh, Descente is there, it's the arrows. They've recently made some other acquisitions, kind of trying to buy brands with heritage that they can turn around. And they've got a great track record of doing that. So they recently bought Jack Wolfskin, which is a German brand, and they've also got a listed subsidiary, which they own about a third of. They listed it about a year ago in the States, and they'd acquired all these other stakes and brands. So Arc'teryx, Solomon, Wilson, and done an unbelievable job of turning them around. And taken that kind of group of global brands to very high profitability growth. Go on the next one there. So it used to be loved. It used to be because it was growing, very highly rated. And in the orange here, you can see their earnings per share. So pretty consistent earnings per share growth over turbulent times. I mean, COVID was somewhat of a detraction, but consistent earnings growth. However, if you look at the price, which is the blue line, it's trading about 75 Hong Kong dollars a share at the moment, which is the same price was trading in 2020 when earnings were less than half of what they are today. So people were, very keen to pay for growth. The growth actually came to fruition, but it's an important lesson. When you pay too much for growth, even if the growth happens, you can lose money. So it's something we have very close to our hearts of being very cautious to pay for growth, because it may happen and the stock derates, or it may not happen and you really lose your shirt. But nonetheless, you can see it's been a growing business. It's grown for the last 35 years. The other important thing, it's been successful in China. China is a brutally competitive place. It's many Western companies have suffered in China just because it's so competitive. And now they're starting to move from China to global, and we think they should find success there. So very high cash conversion, and then net cash in the business, 15% of the business in net cash. And then they've got the stake in Amer Sports, which is worth 30% of the market capitalization. But Amer Sports, listed in America, as American companies do, trade on a very big valuation. So it actually only accounts for 10% of their earnings. They account for as an associate. But if you took this as a value, it's 30%. And on to the next one. So, I mean, all businesses have risks. So we don't want to kind of sugarcoat things. It's a big business now. It's not a minnow. It's harder to grow when you're big. It is relatively high margins. Margins by 22%, which is high for this kind of business. One of the reasons they are high is in China, they do not sell through wholesalers. Basically, 90% of their sales are product they produced, product sold through their stores. So in effect, they're capturing the retail margin as well as the brand margin. So that's why their margins nonetheless are high. So what mitigates the risks? The valuation, about 12 times earnings for a growing, extremely good quality business. And when I say good quality, what do I mean? I mean high cash conversion. So there's a very big difference between a business on 12 times earnings that converts 90% of earnings to cash, and a business on 12 times earnings that converts, say, 50% of its earnings to cash. Okay. Why? Because a business with high cash conversion can effectively distribute all that cash or grow much faster. They got a track record of success. And something else, and it's pertinent to the next slide, some of these athleisure brands have slowed down, but actually in Anta's Q1 numbers, they are growing revenue 17% year on year. So that's actually definitely a slowdown. Revenue growth has actually accelerated. Now, if we look at some of the comps, you can see Anta highlighted in red, a big business, $26 billion, definitely not a minnow. Growing revenue, 17%, growing revenue 19%, trading 12.5 times earnings, decent dividend yield, 3.5. You compare that to, let's compare it to Adidas, because Nike's got issues, but Adidas has only grown revenue 4% a year for the last 5 years, so much slower. But people put Adidas on 17 times earnings rather than 12 times for Anta. The stocks that trade on similar valuations to Anta in terms of PE are Deckers, which owns Hoka, and Lululemon. And I think there is a difference between those companies. The difference is Deckers is basically a one brand company. Yes, they do own UGG, but most of their profits come from Hoka. And Lululemon is a one brand company, and Lululemon and Deckers have both hit growth walls in America. Funny enough, Lululemon is growing very strongly in China, a very premium brand in China. So as you can see, like people pay up for, we think too much for single brand companies in the West, while actually a company like Anto, which has been successful in the world's hardest market, now starting to grow global, and that big difference of management here, and this is very consistent with the majority of our Chinese holdings, is we betting on people that would have proven success. I truly think, and the longer I do investment for, the more I think this is certain business people are better than others. These are all entrepreneurs running these Chinese businesses who've grown their business from nothing rather than, no offense to Sean, who's an accountant, but like some CFO who's been promoted to run the business, which happens, it's like surprisingly often. Like, would I rather back a guy who's grown a business from his garage to 25 billion, or the CEO or CFO who kind of was promoted because the CEO left and there was no one else to take the role? Okay, so I think it is something that matters. Thanks,
Brilliant.
Sean.
Thanks, Andrew. Right, so this is a style box. What we've done here is we've taken the 20 largest funds in the IA, the Investment Association Global Peer Group, and those funds account for 228 billion. And we've got a scatter plot, and this is a Morningstar scatter plot. And so what you have on the x-axis is value, blend, and growth. So the further the fund is over on the x-axis, the more growth orientated the portfolio is. The further they're over onto the left, the more value orientated. And then on the y-axis, you've got small, mid, and large, and that's the size of the companies. And so what you can see here is that most of our large peers are up here in the large blend box. The red is the average. We, on the other hand, are over here on the far left on value and mid. And so, as Andrew so eloquently described, Anta, that's a typical kind of business. You've got Expedia and Anta. These are well-known businesses, but they're not massive, and so therefore we think there's still growth opportunities, and we are paying less for them. And so again, very different to the average funds out there, and that offers diversification. If you say, well, are you taking on more risk to be so different? Well, what you have here is the 3-year annualized standard deviation on the x-axis and 3-year return per annum on the y-axis to the end of May. And again, what you can see is actually slightly lower volatility and slightly higher return. And again, it highlights just how we like to use volatility as our friend. When I mentioned Expedia selling off, and taking profits and then reinvesting. So that's on our risk and return chart. In terms of what's top of mind right now, upside and downside in Morningstar data, the upside capture, what is that? That is in positive months, what percentage of the return have you captured, has the fund captured on average? And you can see it's 92%. Our peers have captured about 89%. But in negative months, what percentage of return have you captured? Well, over the last 5 years, the average has been about 62% and the peers 109%. And that's really, we stay in our lane, we do what we do, we don't worry too much about the market. But it was interesting. The other day I was asked in a meeting, what did the fund do on Friday when the market was down 2.6%? Now, it's a single data point, don't read too much into it, but we were only down 0.3. And again, it just speaks to the lower downside. Okay. Andrew, do you want to chat about the valuations and the sectors here?
Yeah, thanks. We don't. It's funny, people say, oh, you guys must love Asia. You're always going investing in Asia. It's not that, it's just we get led to where we find opportunities. We're screening thousands and thousands of stocks, and our portfolio is very much bottom up. But then if you do look top down, just as a sanity check, you can see potentially why are you there. And what this shows is this is not our data, it's kind of MSCI data. And if you look at North America, so according to all the analysts out there, North America is on 21 times forward earnings, and I would argue those earnings are high. But the 25-year average is 18 times, so it's trading at actually above its long-term average in terms of PE. And then Europe is kind of in line. But then you can see some of the markets where we are, Asia, LATAM, other EM, actually trading at below their long-term valuation. So if you think Asia, 25-year average, 16 times earnings, is currently trading at 14 times. So naturally, if you saw this, you'd say, oh, you guys must have more exposure to Asia. And you'd be dead right.
And that's what
yeah. Sorry, go ahead, Sean.
Yeah, that's what that shows. And so what you can see, thanks, Andrew, you can see the blue is what the MSCI World Index weighting is in North America. It's over 70%. Well, we have around 25, 26% in North America. Very different from our peers. In Asia, and here's an interesting stat, Asia actually has 60% of the world's population, accounts for 30% of the world's GDP, and only 10% of the world's market cap. Okay. And if you just sort of say, well, let's just pretend the world top sliced and we went from 73 to 65%, this would be the weighting in North America would still be up here, 65, still quite extended. That is double the Asian weighting. Okay,
Do you know what I'd like to have? I'd like to know what percentage of the world's science graduates come from Asia. The reason that matters is because all these punters out there think that China can't do AI, and the only people that can do AI is America. And I'd like to know what percentage of people who are studying that kind of thing are actually in China and India. But yeah.
Well, we can get that number. My bet is going to be closer to the 60% of the population.
I think so, or more.
All right. So what you can see is, we just offer something different, and we go where we find value. And right now, we finding value in Asia. I'm pleased to say it's been some work which our operations team have been working in the background for quite some time, updating our website. We are using FE Fund Info for the back end for the screener. So there are a couple of new things that we have on the website, and this is a table of all the classes, and you can go there and look at the performance. It's got the latest prices. You can, plot the performance versus the IA sector, get the documents, etc. So that is the one part. And then what we've also done is made our historic fact sheets available, so you can go and see what we said back in 2022 and how wrong we might have been in most of those, I guess. But have a look at the website, and if you've got any comments, we'd welcome any feedback. And for those who don't subscribe to our fact sheet, please do. It's one of the ways we know many platform investors don't know that we have these monthly fact sheets, and we can't get access to who the underlying platform investors are. But what we do is we try and write a story about one of the stocks we own, something we've got wrong, rather than just sitting back and saying, well, we think the oil price is going to do this and we think the gold price is going to do that. So please do have a look at our website. So in conclusion, we focused very much on long-term real returns. That's where we invested in the fund and significantly invested in the fund. And we very excited actually about the return opportunities we have for our portfolio at the moment. In terms of the expected internal rate of return that we think our positions hold or offer. And so we're differently positioned to most funds. That diversification helps the underlying clients stay the course. We also need to recognize the future is always uncertain. Think about the tariffs, think about the Iran war. If we knew all of those things, would we know what the market's going to do? We don't. So that's why we don't spend too much time worrying about the market. We just focus on what we can control and the underlying opportunities. But always mindful that every crisis yields opportunities. And so software has sold off. Some software stocks we think deserve to have sold off, especially given their stock-based compensation. We find some opportunities there. And also just to highlight that value as a strategy has historically helped protect in recessions and recoveries. And so, in summary, I guess we invest differently. That means we perform differently. We charge differently. We're lowering our fees as our assets grow, and we give back differently. And we've got UK and South African charities, and involved in venture philanthropy here through our partners, the Four, and in South Africa. So that's really all we're going to say, other than we got a whole lot of questions. So now this is when Howell comes to the fore. And Howell, do you want to ask some questions?
Yes, Sean. Okay, the first one is, how long are you willing to wait for the market to reward these cheap equities? Can you explain this process, and what happens if after 2 years the market still hasn't re-rated an equity?
I mean, so we look, when we invest and we build our models and we do the research on what we think a company is worth, we go back and look over time. What does this business generate in cash? What do we think normal margins are? What do we think they can earn in the future? You get an expected return. Okay, and so the important, and we reevaluate that every time the company is reporting, every time a competitor, you think, well, have we got this right? Have we got it wrong? And so that's what we'll do. So, just if we invest in something, let me give you a perfect example. We bought a small position in Western Union, and, we thought the stock was very, it had fallen a lot. On the face of it, it looked cheap. They'd done some interesting deals. But after a couple of quarters, I actually, I changed my mind, and I was in favor of the company, and I changed my mind. I just thought it's the more competitive environment. They've got a higher cost structure, and they're spending a lot of money buying back shares and, building up debt, and the attractive dividend maybe is not sustainable. And so we actually sold. Now, I think from start to finish, we might have got out square. I know the first part of the price, the portion of the portfolio, the stock holding, we actually made some money, and I think the last little bit we lost a little bit. So we didn't lose too much money, and I guess that's the thing. So we're constantly reevaluating: have we got it right? Have we got it wrong? What's the price now? Do we think we can make a double-digit return?
I think the other thing that's important to add there is, for so-called value investors, we actually quite like growth. And growth comes in a few ways. The main way is management consistently doing intelligent things. So is the underlying value of the business increasing or decreasing? If the underlying value of the business is increasing and the market is just ignoring it, that's absolutely fine. We'll wait for a very long time. But if you're in, and Western Union, actually, it's funny that you gave that example, was that a winning business and the underlying value growing or not? It was probably not so much, and hence we changed our minds. So, yeah.
Thanks, Andrew.
Thank you. Thanks. Sean, sorry, if you want, you can stop sharing the screen if you want to.
Okay, thanks.
You can go a bit bigger.
Yeah.
Can you talk about managing risk of Asian exposure in a potential scenario of China's invasion of Taiwan?
I mean, I guess, well, let me start off there. If China invades Taiwan, I don't think you want to own any of the large technology companies, I guess would be the first point. The second point is, how many countries has China invaded recently? And let's compare that to how many countries America's invaded or thought about invading or attacked. So, I think the other thing is we own Hong Kong stocks. So what happened with Russia and Ukraine, when Russia invaded Ukraine, the Russian holdings that we owned were listed in the UK, and those got suspended. Okay, in Hong Kong, we own the Hong Kong stocks. We don't own for most part, the ADRs in America. So the risk that those companies would be suspended is it's far lower. I doubt they'd be suspended in Hong Kong. But that would be a risk for global markets, and it would be a risk for certainly the large technology companies, Taiwan Semiconductor, and yeah. Did you want to add anything, Andrew?
No. Yeah. So we hope it doesn't happen. We think it's relatively unlikely, but it is something we think about a lot. And also there was another question I see a few times is what percentage of our Asian exposure is actually in China? And Sean can look that up quickly. But we do also have exposure to Indonesia, Philippines, Korea, South Korea, and Japan. But Sean will look out for our exact, and we'll get back to you on our exact China/Hong Kong exposure.
It's 19%.
19, thank you.
Yeah.
Okay. Up to what size do you think you can play in the mid-cap space?
Well, it depends on what you define mid-cap. So how Morningstar defines it is it's per region. So a company, 29 billion would be considered mid-cap, but actually in some places would be considered that probably is a mid-cap, but $7 billion would be considered a small cap in the US, but actually a mid-cap in other regions. I mean, if you look at the percentage of one of the things that defines our potential capacity, is first of all, we have smaller positions, so we don't have 10% positions, we have 2% positions. That means from the get-go, your capacity is greater. The second thing is if you look at the median percentage of shares that we own in each of the companies, it's less than 1%. Okay, so that's an important point as well. We don't own 10 and 20% of companies. And then I think the third point is that, as we grow, value investors typically buy a little bit too early and we sell too early. And so the fact that we've been getting inflows meant that we could continue buying B&M and we could continue buying EasyJet. And we were early in those ones. Andrew,
yeah, we've always used $4 million a day trade as our cutoff. We don't buy stocks that trade less than that. And just to put some numbers on Sean's, we manage about $2.5 billion at the moment, which is a lot to be grateful, very grateful for all the support you've given us. But just for context, I mean, we own maybe 3 or 4 companies that have market caps less than $2.5 billion. So if it's 2% of our portfolio of a $2.5 billion company, it's only 2% of their shares in issue. So, and we could potentially own maybe 5% of their shares in issue. So just the current portfolio, we could manage 2.5 times more than we currently manage and still be less than 5% of shares in issue of our smallest companies we've invested in.
Okay. With the conflict in the Middle East and little chance of agreement, inflation may continue to rise and the strong possibility of recession if this continues. Would that alter the fund strategy? And if so, in what way?
Well, it's created opportunities, we think. And let me touch on some of those opportunities. So we increased our position to EasyJet as well as Jet2, another airline. At the high oil prices, it's given us an opportunity to buy something like HBX, which is a corporate-to-corporate hotel booking platform listed in Spain that people are nervous about. It's also opened opportunities. We think the Philippine banks have been very cheap because people are very worried about Southeast Asia, the Philippines, Indonesia. Indonesia, it looks like the opportunities are rising there, which we look to take advantage of. So do we think the crisis is going to be solved soon? I don't know. I hope so. But we're not betting on it. And all the companies we buy, we make sure they can survive through a protracted downturn. But we do not forecast. It's just not what we do. We don't forecast recessions or growth for that matter. We look for companies that we think will thrive in all environments and are hopefully very depressed because people are particularly worried about certain scenarios.
Hal, there is one question here I'd like to just address because I think it has broader, it's of broader interest, and that is, do you have any exposure to armaments? And no, we don't have any exposure to armaments. And what's interesting is if you knew for certain a few years ago that there were going to be these wars, okay, what would you might have thought? Well, I think there's high likelihood that there's going to be wars and therefore we're going to buy defense companies. And that's knowing with certainty we've had the wars. Well, interestingly, the American defense companies have not those stocks have not really outperformed, they've underperformed, if anything, over recent years. And why is that? Because you didn't know that the war would take place in an environment that's changed. Why do you need who needs very expensive aircraft when they can get taken out by a $5,000 drone? And tanks are hugely vulnerable. And so the whole environment of war is changing. And that's why it's a great example of why we don't pay up for stories and we're not thematic investors like that, is because you just don't know how things are going to play out. I mean, we were talking about this the other day. Andrew, was there anything you wanted to add to that?
No.
Yeah, I mean, and that's knowing with certain that there were wars, and yet that's not been the place to be. So,
Okay,
right.
A couple of questions on the theme of alignment and whether you're both invested in the fund.
Yeah, absolutely. I mean, I don't have any money other than a little bit of cash, and everything else is invested in the fund alongside clients. And our business is now paying dividends, and whatever doesn't get donated to charity gets invested in the fund alongside clients in the same classes as everybody else. So yeah,
Yeah. I have some historic investments like the Alan Gray Africa Equity Fund, which I used to look after like 6 years ago and things like that. But all my flow, any dividends, any income I have managed to save, I stick in the Ranmore Global Equity Fund. Same class as everyone else.
and that goes for families. We don't actually have a class for family and friends of family or anything like that. If we can't charge our own family members that fee, then we're certainly not going to charge it to external clients.
Okay. Do you not see any opportunities in the semiconductor sector, not end users, but suppliers to the NVIDIAs, etc.? For example, Lam Research, Applied Materials.
Andrew, do you want to start there?
No, I mean, if they were trading cheaply, that would be fantastic, but they're not. And the people who saw that early, I mean, kudos to them. The people who saw the things running and they saw the memory and they saw the suppliers to the memory. That's fantastic. They've done very well. But it's something I do want to touch on here. It comes back to that point to competition. And it amazes, like commodity businesses. What has happened to all commodity businesses in the last 10 years? Chemicals, batteries, cars, okay, cell phones, except for Apple, any kind of where the only barrier to entry is solar panels, where the only barrier to entry is capex. China has decimated those industries, and the only barrier to entry to memory chip manufacturer is basically capex. And there's a company that's just by the list in China called CXMT, which grew revenue 7 times year on year, which has now got people think about from nothing a few years ago to 10% of the memory chip market. And yeah, so just an industry that's attracting that kind of capital and heat is not for us. And whether it be Lam Research, yes, ASML is a very strong position, but the other companies I think starting to compete with them from Japan, etc. So no, we're not in that sector at all. And it comes back to our core philosophy is where capital is flowing to an industry in great volumes, whether that be in the stock market or in the businesses in that industry, it's something we avoid.
Yeah. And also just to also highlight that, the only ways in which you can benefit from AI are not necessarily the equipment manufacturers. If you go and read Anta's accounts, financial annual report, as I did recently, they refer to using AI in their design, in their optimizing of their shipping, in the optimizing of their marketing. You see the same thing with, they're using AI within Expedia. And with most of the companies, actually, I mean, which companies are not using AI out there? And that helps cut costs. But the benefit of those companies is that they're not paying for the capex. So they're getting the benefits of AI in efficiencies and costs and all the rest, but some other companies are spending on the capex. So, so I guess that's the key point, that you can benefit. Companies are benefiting from growing earnings through the use of AI. It doesn't have to be only in those equipment manufacturers.
Okay. How important are dividends being paid out to you as a form of capital discipline from management versus the potential to organically reinvest?
Very important. We like companies that are cash flow generative, and that's why we like companies with net cash in the balance sheet and not net debt. Because if a company is so cash flow generative, why does it have debt? So it's a core part of the return we get. If you look at the stock market in the last 100 years, the vast majority of real returns you received has been through dividends. So it's important to us. I mean, some companies, they buy back stock because more tax efficient than dividends. But stock buybacks, we can do a whole another podcast on that, because a lot of stock buybacks, particularly in America, are just offsetting dilution from share options or restricted stock units. So cash flow in a concept, and therefore returns of that cash to shareholders, very important to us.
Yeah.
Okay. A number of value managers are saying quality stocks are trading at value multiples. Are you finding it easier to find good ideas?
I mean, we are seeing, well, you're seeing that, some of these companies that have been quality businesses and loved by the quality managers in recent years are down at levels that we now finding attractive. Sure. I mean, one company that we've been buying recently is Tencent. I mean, never did I ever think that I would be buying Tencent, but it's a fantastic business. It's back at the same price as it was many years ago, despite earnings having grown. Yeah. I mean, so that's certainly the case. Andrew, do you want to add anything to that?
Yeah, so a few things like 10 cents. So also, I think you've got to think carefully about what businesses have real staying power. And I think network businesses like 10 cents actually probably have more barriers to entry than just general software or businesses like that. The other thing is a lot of people got excited about that whole word quality, a few years ago. And a company like Diageo, we own Diageo, the liquor producer. It's, I don't know, down 65% or something from the peak. But in truth, Diageo is never a great business. We own Diageo because it's an okay business at a fair price, but it's not a great business. And what I think people got confused about, they got confused about the share price going up a lot, but meaning it's a great business. No, it's not a great business. It's a good business. And now I think the price got excessive, 25, 30 times earnings, but at 12 times earnings, that's a good price.
Yeah. And also, we're also mindful of the fact that businesses can change, So brands used to be a fantastic business because the barriers to entry were high. You needed to have deep pockets and advertise on mainstream television, and that was a barrier to entry. These days, that's not a barrier to entry. You can launch your product on Instagram or YouTube, and so proliferation of brands has changed. Airlines used to be terrible businesses. Well, Michael O'Leary and Ryanair have proved that they don't have to be. If you buy your aircraft at the right time, if you use technology for real-time demand, adjusted pricing. In the past, when the airline wanted to change the price, they'd have to fax travel agents around the world. Now they can do it in real time. So, we're always mindful of the fact that businesses can change and that what was once a great business doesn't always remain a great business. I see here there's a question just jump in. How have your funds performed against pure value managers over the last 12 months? I mean, we obviously competitive people and we do look at what our peers, so I guess it would vary from one manager to another. And some of the value managers who perhaps had more in oil stocks when the war broke out have outperformed us. We haven't had material stocks. But really what we do is we just stay in our lane, do what we do. And what the competition in the market, what'll be will be. But if you relate that to property, it's interesting. If you're a residential property investor, let's say in London, okay, and that's that's what you do. You specialize in property in London. Do you really worry about what the property is doing in Liverpool? And you can chase your tail. And so we just do what we think makes sense. Only interested in long-term decent businesses that are growing earnings and buying them at attractive prices. And sometimes that return, we'll wait until that return is unlocked, and sometimes it gets unlocked quicker. But we really stay in our lane and do what we do.
Okay. Should we naturally think that the fund will always be skewed towards less cyclical areas of the market?
No. Yeah, I don't think so. I don't know.
No, I mean we've owned Glencore in the past and Thungela at the right price. We've owned Mosaic. There's lots of cyclical businesses.
We've owned financials. We own, which I guess is a cyclical sector. Retail is cyclical. Yeah.
But we're very price dependent, and so we're not going to pay up for a cyclical business. Off the belief that, because so often what happens is people then, if the cycle just extends a little longer than expected, then people convince themselves it's no longer a cyclical business.
Does SpaceX's IPO pose a challenge to active managers in your view, and why?
I mean, it's an opportunity, isn't it? And that's probably one of the things, that there's been huge distortions going on potentially with flows of people making raising cash to invest in SpaceX. I mean, we don't. Is it? Yes, it's an opportunity because it is going to be in some of the passive funds. It is attracting some retail money, and that as money gets sucked out of other areas of the market, opportunities will arise.
Just to be clear, we're not there.
That's what.
Okay, I think probably time for just one more, maybe. Are you using AI in your investment process, and if so, how?
Yeah, we are using it in some places. So, for example, one of the things we like to look at is conference call transcripts. And in the past, you used to have to listen to conference call transcripts, take an hour, and then you could read them and it'd take 15 minutes. And now you can get them summarized. If you're looking at a pharmaceutical company and you want some insights into the pipeline, it's a very effective way of using it in terms of the research. So, yeah, certainly.
Okay, I think we're at time there, Sean.
Is that it? All right. Great. Well, listen, just in wrapping up, thanks everybody for taking the time. Hopefully that shares some insights into how we invest, how we think, and explain some of the recent performance and how we generated our returns over the long term. Feel free to get in touch, via client services if you've got some pressing questions. I will endeavor to get to most of these questions and answers, and reply directly. But thank you for your interest and your support. Andrew?
I echo that. Thank you so much for your time. Appreciate it.
Thank you. Thanks, Dan. Dan?
Yes, Sean, hi. Sorry, we're still broadcasting. We're still live.
Oh, are we? Okay,
Yeah.
Sorry.
So we'll chat on the group.
All right.
There's a highway of stars across the heavens. There's a whispering song of the wind in the grass. There's a rolling thunder across the savannah. A hope and a dream at the edge of the sky. And your life is a story like the wind. Your life is a story like the